Hi, and welcome back to the Food Fund, where we analyze investing in food, beverage, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is a once high-flying energy drink company a good investment? In this video, we will be analyzing if CELH stock is a buy. Could CELH, stock ticker symbol CELH, be ready to rebound higher? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on CELH. CELH was founded in 2004. The company produces a range of fitness and energy beverages under the brand name CELH. The company's products are marketed as healthy, a strategy that has contributed to the brand's significant growth. CELH has over 1,000 employees and its headquarters is located in Boca Raton, Florida. Now let's look at the price action. Starting with the one-year chart, we see that CELH had a CAGR of about -48%. Zooming out to the 5-year chart, we see that CELH had a CAGR of 78%. CELH has a long-term track record as a grower, but is certainly in the midst of a pullback in the short term. In my opinion, this is a great setup as the company has already proven it is a grower. It just seems to be on sale now. A backtest comparison of investing $10,000 in CELH versus the S&P 500 reveals a stark contrast in their performance. An initial investment of $10,000 in CELH grew to a substantial $1,707,000, translating to an impressive annualized return of 67.92%. In comparison, the S&P 500 yielded a more modest ending balance of $34,808, a return of 13.40%. This highlights the significant outperformance of CELH in terms of overall growth. However, CELH also exhibited considerably higher volatility compared to the S&P 500. The standard deviation for CELH was a substantial 76.55%, indicating greater price fluctuations, whereas the S&P 500 standard deviation was 15.35%. This volatility is further evident in the extreme performance figures. CELH experienced a best year with a staggering 941.61% return, far surpassing the S&P 500's best year return of 31.22%. Conversely, CELH also suffered a significantly larger worst year loss of -47.82%, compared to the S&P 500's -18.17%. The maximum drawdown, representing the largest percentage decline from a peak to a trough, further emphasizes the risk associated with CELH. CELH experienced a maximum drawdown of -65.69%, considerably larger than the S&P 500's maximum drawdown of -23.93%. Risk-adjusted performance metrics, however, favor CELH. The Sharpe ratio, which measures risk-adjusted return, was 0.99 for CELH and 0.79 for the S&P 500. Similarly, the Sortino ratio, which focuses on downside risk, was 2.39 for CELH and 1.23 for the S&P 500. While both values are positive, indicating positive risk-adjusted returns, CELH clearly demonstrates better risk-adjusted returns. Now let's hop over to market share and take a look at CELH's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under beverage and see that CELH is categorized as a beverage company. Expanding the non-alcoholic beverage tab, we can see that CELH has the third smallest market share of the companies listed, but is growing its market share the fastest. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for CELH, CELH, and see that the market share is 0.17% out of the publicly traded food, beverage, and restaurant stocks currently in the market. CELH has very little spend but has been growing market share rapidly. The 5-year market share CAGR for CELH is 79.7%. This means that CELH's market share is outpacing growth in the wider industry. If we start in 2020, we see that the market share was 0.02%, 0.04% in 2021, 0.08% in 2022, 0.16% in 2023, and 0.17% over the trailing 12 months. Notably, the rate of market share growth has slowed since 2023. Still, the company is gaining market share. Let's take a look at the fundamentals to learn more. Gross margin is 50%. This is very good for a beverage company. Revenue has compounded at around 87% over the past 5 years and has reached over $1.37 billion most recently. Celsius revenue had been growing very quickly but has started to slow down tremendously. When we look at cash flow, we see a 193% CAGR over the last 5 years for operating cash flow, while CAPEX has worsened at a 168% CAGR. As a result, free cash flow has grown at a 198% CAGR. Strong margins have really helped Celsius generate a tremendous amount of free cash flow, and I don't expect this to slow anytime soon. Weighted average shares outstanding have grown over the last 5 years, going from 223 million shares in 2020 to 237 million shares most recently. Celsius has been diluting shareholders. This is not what I like to see. Celsius should start using a small amount of their massive free cash flow to begin buying back shares, especially at these price levels. Now let's view return on invested capital. Return on invested capital has grown from 13.7% in 2020 to 34.4% most recently. Though the value has decreased slightly from 2023, the overall trend is very positive. I am looking forward to future return on invested capital growth. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 65 days in 2020 to 129 days most recently, Celsius has gotten less efficient over time. The positive note here is that the cash conversion cycle value is down from a ridiculous high of 210 in 2021. As the Pepsi inventory issues are largely behind us, I expect this value to continue to improve. Now, let's look at Celsius debt. The net debt to EBITDA has actually increased over time, going from negative 4.4 in 2020 to negative 3.8 most recently. Keep in mind that a negative net debt to EBITDA in a profitable company means that Celsius has more cash than debt. With interest rates falling, I would be okay with the company taking on more low-cost debt to catalyze growth if needed. Still, negative net debt is a strong position for the balance sheet. I know I say it all of the time, but Celsius still looks like a great company. In any event, is it a buy? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Celsius. It is a beverage company with a gross margin of 50%. The 5-year revenue per share CAGR is 82%, and the 5-year free cash flow per share CAGR is 193%. This is a strong gross margin with great revenue and free cash flow growth. A return on invested capital of 34% is outstanding. Next, the cash conversion cycle of 129 days is ridiculously high but seems to be getting better. Concerning debt, a net debt to EBITDA of negative 3.8 means that Celsius has more cash than debt. So from a fundamental standpoint, Celsius still looks amazing. Now let's switch our attention over to valuation. The price to earnings growth, or PEG ratio, is 4.5, indicating that Celsius is overvalued relative to their projected earnings growth. Celsius has been a high-growth beverage company for a long time. The recent drawdown is its largest in 5 years, though a similar 60% pullback occurs just 2 years ago. The fundamentals speak for themselves. Celsius continues to grow revenue and take market share, albeit much slower than in previous years. Still, I have no reason to think that Celsius won't continue to grow given their pricing power and international expansion set to accelerate. I do wish that management would take this opportunity to buy back shares while they are still cheap. Clearly, I am bullish on Celsius as the company sits in my portfolio. While it may take time to recover, I do expect both the fundamental and the share price to be better in a year. Until then, I must wait and hold against the volatility. Overall, I give this company a 9 out of 10 using my proprietary scoring system. Many thanks for watching. What do you think about Celsius? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now, and don't forget to put your money where your mouth is.